For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. We're managing your financial future as we do so often on this particular program. Welcome to the show. I'm your host, podcast host, Johnny Dean. Not an advisor, but of course, here with my favorite advisor. Well, only when you're in the room.
Yeah, when I'm the only one in the room.
Well, I'm always happy to have you in the room. Professor Rick Plum, CFP professional, certified financial planner, advisor to the advisors, if I may say that. And I think I can say something like that. It's always good to have you in the studio. And I keep telling people how, we've been doing this for 25, I don't know how long we've been doing this. A long, long time. And personally, I can say this with no doubt that sitting in the studio with you and the other folks that I have over the years has taught me an incredible amount about money, about finance, about buckets, about strategy, and all that stuff. And I've told many people how when I first started this back in the 90s, I knew nothing. I don't even think, and I was in my 30s back at that time. I don't think I knew anything about. I don't even think I knew what a mutual fund was.
Well, I can say by knowing what you invested in March of 2000, you didn't know anything about what you were doing.
Well, I didn't, and see,
you took advice from somebody who was very energetic, very wonderful to listen to, but may not have understood exactly what was going on in the world.
It looked like a great deal. Tech-wise, and it was great for 10 days, and then the tech bust happens. But this speaks well, though, Professor Plum, to some of the stuff we're going to be talking about on this podcast today. Now, the title or the topic is going to be Roth conversions, and I'll get into that in 1 second, but I'm going to take 30 seconds. And I hate to be nitpicky. I hate to do this.
But you're going to.
On just a quick separate sidebar topic, Professor Plum, you ran across this.
I'm always reading different articles on taxation. I know it's weird, but I look for articles on taxation, Social Security, what they're looking to do, trying to get an idea of what could happen to the taxes in the future, what could happen to the Social Security benefits if the supposed trust fund goes to zero. I saw something just the other day where there's a renewed effort to get rid of the windfall elimination provision and the government pension offset.
Okay.
Whether or not they can do that or not, we'll see. But so I'm always looking for these things. And I ran across this one article talking about the Tax Cut and Jobs Act. And, for the most part, it was pretty fluff. And there was one piece in it there, though, that I thought, how can you be so wrong?
I love it when you send me these things because you'll forward one to me and you say, look at what this idiot said.
And at first it was like, I'm not going to be that picky. I'm not going to send it to John. And then he came up to my office and I said, John, you got to see this.
And I said, I got to bring this up. So just very quickly, because this doesn't have anything to do with the topic, but it says Social Security benefits may face a threat. And what it's talking about is when the Tax Cut and Jobs Act expires at the end of 2025.
Right. This is the so-called Trump tax cuts that went in 2018, and we had different standard deduction, different brackets, and all that. They sunset at the end of the 2025 tax season.
So it's a couple years away. So what they said was the expiration of tax cuts can also affect Social Security benefits for retirees. Under the TCJA, up to 85% of Social Security benefits are exempt from federal taxes. Huh?
No.
However, once the legislation expires, this exemption may also change, resulting in higher taxable income for boomers. Professor Plum.
Well, first off, up to 85% of your Social Security taxes benefits are not exempt from taxation. It's all dependent upon your other income.
It's the opposite.
And up to 85% of your Social Security benefits may be subject to taxation. And the Tax Cut and Jobs Act had nothing to do with that. It didn't change it in any way, shape, or form. This is just very poor reporting.
It's bad reporting, and there are people who would read this and say, well, wait a minute.
It's a scare tactic.
I've been paying up to taxes on up to 85% of my benefits because of my other income. This says they've been exempt from taxes. Well, I'm going to go back and refile.
It said up to 85% could be exempt, which means the other 15% is taxable. And that's not true either.
All right. That's enough. Don't mean to go off on that.
So basically, be wary of what you read. We've mentioned this many times.
Yeah.
Because sometimes in a rush to get it out, the article out, they get the terminology exactly backwards.
Well, this was not only it was both backwards and inside out. I mean,
and
it was wrong
just
and wrong.
Flat wrong.
All right, so we got that out of the way. Roth conversions. Now, we talked a year ago, Professor Plum, in fact, just about a year ago, as of this recording, about the topic was the markets are down, which they were, is now a good time to do a Roth conversion. And that was the title of that episode, and we talked about how, as we're approaching the end of the year, maybe you should think about doing Roth conversions. Now, you mentioned to me earlier today, as we were talking about topics and ideas and things like that, and you said, now might be a good time to think about Roth conversions.
Well, I think last year we talked about it in maybe a little bit more earnest, because when the markets are down, I think is a really good time to do Roth conversions.
Sure.
But just because they may not be down as much doesn't mean that Roth conversions are not still an important potential strategy for what you're trying to accomplish. I think towards the end of the year is when we should be looking at, should we be doing Roth conversions? Whether we're getting close to retirement, early in retirement, or even later in retirement, what is the benefit, if any, of creating more taxable income today to avoid potential future taxation when we take the money out later of the Roth? It's not for everybody. There are some people who should not be doing Roth conversions. But whenever you're doing your planning and towards the end of the year, now that we've gotten most of the year under our belt, we know what our income looks like. We have a good idea. We can do a pro forma income tax return and say, yes, I expect to be here on my income tax brackets. I have more room, or I've already jumped into the next bracket and we had a big year and I don't want to do any conversions. But it's a good time to be looking at whether or not we can take advantage of something in the tax cuts. So that's just now's the time to be looking for it.
So you talk about doing a pro forma tax return. This is the kind of thing that you do with somebody when you're sitting across the table? Sure. So you say, hey, if you did your taxes right now, let's see what would happen.
Right. So we know we can take a look at this. So we got a retiree. We know what their Social Security is. We know what they've been paying. We know what they've taken out of their IRAs. We know what their pensions are. So where are you on the tax situation? Are we in a bad situation for Social Security? Have we already bypassed it and we're already at the where Social Security is already being affected? Do we have room in the 12% bracket? Do we have room before we hit IRMA? And then we're looking forward to, or I don't have to say looking forward. We're looking ahead to when the required minimum distribution comes out, and what is that going to do to these other incomes? Are we taking out enough money from the IRA today to satisfy what would be an RMD if we were old enough? And so we build this all into the planning process so that we can try to levelize, minimize, monitor, manage the tax hit, not just today, but for the rest of time. And so we're looking at all these little pitfalls. What bracket are you in? Are you being hit by Social Security? Is there something we can do about that? Taxation on Social Security. Are we worried about IRMA when the required minimum distributions come in? And so we look at, can we develop a plan of action? I'm working with somebody right now who has not started. One of them has their Social Security. The other one has not started, not going to start for about 6 more years until they hit 70. And they're looking at, they want to have X amount of dollars in overall income. And so we've decided we're going to take a little bit from personal, but the majority of the income is going to come out of the IRA tax deferred accounts to use the lower brackets while we have them but that does a couple of things. It keeps us, the IRA from growing too much. The personal account will grow more, and that keeps the RMDs in check later on. Now, the amount of money we've set up for them to take is more than they're spending. And so the idea is to go through the year, spend whatever they want to spend, do whatever they want to do. And then towards the end of the year.
Next year, you're saying.
Next year, because we're setting this up now. They're retiring now for next year. And so look at it and say, did you spend what it was designed to spend? And let's say that it was designed to spend $100,000, and through the year they only spent 60. Just making those numbers up. Well, now we've got 40,000 in the bracket that we've designed, and so we can then convert what we didn't spend. So the idea is to create a plan of action where you could take advantage of. Let's make sure we have enough money to spend. Let's make sure we have the appropriate. If we spend on the whole thing, if we go past our budget, fine. We just won't do a conversion that year.
Converting it to a Roth.
But in the years where we don't spend everything that we've allotted for, we'll convert it so the kids can get it tax-free, and it'll help us with our RMDs later on, and it'll help us manage our taxes going forward. In this case, it'll also help keep them out of IRMA in
the income-related monthly adjustment amount
of the Medicare premiums. I had somebody the other day. I was talking. They're saying, "How come I've never heard of this before?"
What, Irma?
Irma. I was like, well, because you haven't been listening to us, I guess.
You should be listening to this podcast.
Because Irma is one of those little tax things that we have to watch out for, and doing conversions. And a lot of times it's that required minimum distribution now that you're 73 or older that puts you up over the threshold for paying a bigger premium, a larger premium on your Medicare tax premium.
That's another issue that comes up when people say, well, I've never experienced this before. I didn't know doing this. Irma's never cropped up. It's the same thing of, taxation of my Social Security. I've never been taxed on Social Security. Well, I mean, there are these things that are going to pop up when you make certain moves.
I was going over a tax return earlier today, and we're saying, well, is your income going forward going to be more like 2022 or more like 2021? 2021 was a fairly high year for you, and all I had was a summary. I didn't have the whole thing. So what was it that 2021 was so good? And they're like, I don't remember my income being that high. Then they gave me the full tax return. You had a very large capital gain.
That would do it.
Oh, yeah. We sold a property. Was that in 21?
Yeah.
And they sold an investment property, which put them way up over the limits, into the big capital gain brackets, into the IRMA brackets, into the,
All right. So now this shows the importance, I believe, of not just doing Roth conversions willy-nilly, just saying, well, I'd love to have more money in a Roth, because it's
a cost.
There's a cost to doing it, right? Yeah. And now what your job is, Professor Plum, as the advisor, is to look at that cost and say, is this cost worth it? Is this going to cost us more, or is it going to benefit us?
We know there's a cost. The cost is today, the taxability of that conversion today. But the whole idea is we don't incur costs just for the sake of incurring costs. Why do that? There's got to be a benefit to what we're spending today. Is that benefit the ability to withdraw money in the future, the ability to not have as large of a required minimum distribution, the ability for our kids to inherit it in a more efficient tax manner? Is that benefit enough to overcome the pain of paying the taxes today? And in some cases, the answer is yes. And in some cases, the answer is no, I don't think so. Well,
and this is what's different, because I think so many advisors, and we've seen this too in the real world, so many advisors might go out and say, don't pay taxes now. Put it off. Don't pay taxes now, because that sounds kind of good. We're going to save you in taxes this year. If you don't add to your tax bill, wait until you're required to do so.
Well, that's common that you read from the journalists. Now, we started off this talking about an article that's looking forward or looking ahead to the termination of the Tax Cut Jobs Act tax brackets. And that's coming up in a couple more years. And so that's one of the things, and it's an unknown because we don't know if Congress will ever do anything beneficial to us and help us and maybe, keep the 12% and the 22% bracket rather than letting it go to 15, 25.
Expire. Yeah.
And if it does, those brackets are going to go up. And a lot of people, especially in that middle bracket, are going to see their taxes potentially go up.
So you got to plan for that stuff.
So you've got to look at that saying, even if my income is the same in 3 years, I may be in a higher bracket just by the default of the sunsetting of the current brackets.
Potentially. So in keeping with the question of whether or not, should you be doing Roth conversions now? The answer obviously is the namby-pamby.
It depends.
It depends. So for somebody who says, well, I'd like to know the answer, is now what can a person do to make that decision for themselves? If they say, well, it depends on what? So can you give us a 60-second, tell us what it depends on?
Well, it depends on what your income is today, what you can manipulate it to be today, and what your projected income is going to be in the future, at some point in the future. Once all your pensions kick in, once your Social Security kicks in, once your required minimum distributions kick in, what does it look like? Does your income look like it's going to be, from an all taxable source and going to be, painful? Because we see people where they've got, some money personally, and they've got tax deferred money, and they live off the personal money, and they live with zero taxes for 5, 6, 7 years.
Yeah.
Because they've got, 300, 400,000 in a bank. What's that earning? Even if it's in T-bills right now, that's earning $15,000, $16,000, $18,000 plus their Social Security. That by themselves, maybe they're not paying any taxes. And then they leave their IRA alone until they're 73 now, and the required minimum distribution kicks in at $50,000, $60,000, $70,000 because it's $1 million plus, and all of a sudden now 85% of their tax or Social Security is taxable. The whole IRA distribution is taxable. They go from paying nothing to a big number. Whereas if they could take some money out now, maybe do some conversions, some tactical conversions, they could keep that RMD down a little bit and blend their incomes, keep it in a reasonable state going forward.
We've said many times, and especially recently, that the investment strategy needs to be is a different skill than the withdrawal strategy, the building of the wealth, as we call it, and the taking
the accumulation phase, the creation of your investment portfolio. The hardest part about that is prying your wallet loose and saving the money. But once you get to your goal and you start distributing the funds, that's a different game plan. It's harder.
It's a different skill, and it is harder. And this is why we've said many times that you need to combine your investments with your withdrawal strategy. And I don't mean that necessarily literally. Well, I do, but I don't want people to get the wrong idea. But your withdrawal strategy needs to be coordinated, let's say,
there's
with
two
your
levels.
investment strategy.
I think you're talking about two different levels. There's the investment strategy, which defines which type of investments you're using to satisfy specific time horizon goals. That dictates what kind of investments you use. And now, once you understand, I need to have this much money in safe, this much money in moderate, and I can afford to have this much money in longer-term growth money. Now it's a matter of which accounts should hold those investments. There's asset allocation, that's the first one, and asset location, which is the second one. Should it be coming from my Roth, from my personal accounts, trust accounts, or should it be coming from tax-deferred accounts? Those are two levels that we have to get right to make sure that you're not spending more on a certain expense, taxes, than you would otherwise need to have to spend. And taxes are an expense. They take away our ability to spend that money on something else because we had to send it to the government.
Which is why the folks at Lucia Capital Group want me to remind you of this, and I'm going to mention this here, that integrating your investment strategy with your portfolio withdrawal strategy, as we've been saying right now, is really essential, all right? If you're aiming for some kind of stable, potentially stable financial life during retirement. So your withdrawal strategy, your investment strategy have to work together. And here's why. Because your investment strategy can dictate how your money is spread out in different types of investments, just like you said.
Right, that's sort of allocation.
Allocation. That affects how much your portfolio can potentially grow and maybe the amount of risk that it has. But the way you withdraw money from your investments has a huge impact on how your money lasts, especially if the market is down. Now, I want to remind you that when you set yourself up with the Lucia Capital Group bucket strategy, it's set up so that during times of market volatility, your cash flow will not be affected. That's how it's designed. You don't have to take less money simply because the stock market might be tanking. And that's what retirement is all about, isn't it? Stable cash flow along with growth potential. That's what they work for. And that's what you get when you invest with Lucia Capital Group. So give them a call, 800-644-1150, and find out what a Lucia Capital Group bucket strategy may be able to do for you. 800-644-1150. Wanted to throw that in there, Professor Plum.
Right. And bottom line is you don't want to have to sell an asset that's in a negative position to raise cash to spend. Now, you may want to sell something when it's down because it's a dog and you need to get rid of it, but you don't want to be in a position where you have to sell a stock or some investment that's down because you need to pay for something. That is the wrong strategy.
That's not a strategy. It's just, I better go sell some stock today because the rent payment is due or the mortgage payment is due. Now, we talk, which is why we speak so much about things like a bucket strategy. And that's what a bucket strategy is designed to deal with.
So we're dealing with multiple levels of risk to your portfolio. One of the risks is that you sell when it's down. That's the bucket strategy aims to counteract that and have enough safe money that get you through downturns. So you never are in a position of selling an asset when it's in a down position to cover a current cash flow need. The other issue is trying to maintain or manage expenses. Now, I'm not talking about managing your travel expenses. Those are fun expenses. I'm talking about managing expenses that you don't necessarily like taxes.
Taxes is a big one.
And that's what we're talking about here. And that's why this time of the year, the end of the year, because we have to have conversions done before the end of the year. They only count in if you're
calendar
done,
year
when they're actually done. Now's the time to be looking at, is now a decent time to be doing it? Now, there's some communication for somebody. I still get people, especially retired individuals, come up and saying, well, I can't do conversions anymore. I'm not working. No, you cannot contribute to a Roth IRA because you're not working. But anybody at any age, at any income level, anybody can do conversions. The only thing that cannot be converted is an amount equal to the required minimum distribution. But anything over and above that required minimum distribution, or if you're not to required minimum distribution age, it can be converted. Now it's just a question of should it be converted.
And that's my question to you.
And how much?
Well, so what role could a Roth conversion play in a bucket strategy? I mean,
it can help tremendously.
It's a big part. It can be a big part of it in certain circumstances.
Oh, it can.
Explain how that works.
Paying taxes today may be a better deal, especially if, let's say, you're postponing taking your Social Security. So you can take money out in the 12% income tax bracket. And whether you're spending it or converting it, you're taking money out and you're paying 12% on it. But you could, and what some people will do, especially if they listen and read the journalists, they leave their IRA as a loan and they start taking money out of the personal accounts, their bank accounts. Well, the only thing that's taxable on a bank account is the earnings on a year-to-year basis. So if I need $50,000 a year and I've got $300,000 in the bank, that'll last for 6 years. But I don't pay taxes on that $50,000 a year that I'm spending. I'm only paying taxes on whatever it earns. $300,000, may be earning, $12,000, $15,000 a year in the early years and less as we go along. And then they're getting their Social Security and they're not paying any taxes. Yeah. But their IRA is growing. It's growing for the next 6 years. And maybe by the time you do start taking it at age 73, now you've got nothing but taxable income from your IRA and your Social Security. So even if the 12% bracket did survive, even if it continues, you're not paying 12% on the money coming out of the IRA anymore. You're paying 12% on the dollars coming out of the IRA, and you're paying taxes on 85 cents of your Social Security that was previously not taxable. So basically, for every dollar you're taking out of the IRA, you're paying tax on $1.85. Even if it is 12%, that dollar didn't cost you 12%. It cost you 22 cents. That's a 22% tax bracket. I went from nothing to 22 really quickly, and that's assuming we still have the 12% bracket.
Well, and it's funny. There are people who recognize this, but they don't know why. They don't know why it happened. Wait, I thought I was in the 12% bracket.
Then why'd that $10,000 IRA distribution cost me $2,200 federally?
Well, you were talking about doing this sort of mock tax situation.
Yeah, pro forma.
And I felt like I'm sitting across the table from you in a meeting, like I'm a client. But you know what? These are the kinds of things that you can do.
Right. Take a look at how much you've been. If you're working right now, still working, take a look at your W-2. It's probably hard to find now because you don't get them with your check because you probably don't get a check. You get an automatic deposit.
Yeah.
So you might have to go look it up online somewhere and see what you've made for the year. Where are we at? How much you've made, your spouse, look at what interest you've made, look at where your income is coming from, and find out where we are with a total income source.
So if I want to find out whether now is a good time for me to do that, first thing I'm going to find out is what my income is so far this year.
Right. The first place to start is now. What is today's current financial picture? And that actually is the easiest. Now, some people say, I don't want to do that. Well, if you don't want to do it, don't do it. Don't do anything, and just accept the consequences of your non-actions.
Well, have Professor Plum do it.
But you've got to go through and do a little work and find out what your current fiscal situation looks like. The harder part is then looking forward into the future. What is my future going to look like? What is my projected Social Security? What are my projected pensions, if anything? What is my projected required minimum distribution? If I'm 60 and I'm thinking about age 73, how do I make that jump for 13 years? Well, it comes down to what is your plan of action. Are you going to be withdrawing money from your IRA when you retire, either now or at 65, 70, whatever you retire? And what kind of a growth rate do you expect? So let's just make some projections and see if we can get close to what it might look like. At least get us a starting point and saying, you know what? You've got $3 million in IRAs. Your required minimum distribution is going to be minimum $120,000. I mean, so how does that fit in? Well, I'm making $500,000 now, so that's going to be a lower tax bracket than what I am now. Okay, but that's what we know. So that's where you know where you're at today. We're making a projection of where you might be in the future. How does it look?
Would you say it's helpful to have the more money you have, let's say in a Roth, does it is it helpful to try to have as much money sitting in tax-free environment?
Poof, make my traditional 401k and all that turn into Roth. Yes, I would do that. But there's a cost of doing that. But yeah, if I could all of a sudden just change it without a cost, in a heartbeat, it'd be a Roth IRA or a Roth 401k Roth IRA. But there's that cost. How do we make that happen? And should we have been doing Roth, or should we be doing Roth contributions to the 401k or IRA going forward, or traditional tax deduction? That again also depends on whether or not what is my benefit today. If I'm putting 50 years old plus and I'm putting $30,000 into my 401k, that's saving me how much in taxes today? Boom, we can figure that out pretty quickly. And then what is my cost going to be when I take that money out of the IRA when I'm 150 years old? 73. Okay, it's only going to cost me Y amount. So which one is
better?
Which one's better? The tax deduction today versus the tax savings later, or no deduction today and
pay for, whatever taxes you're going to pay later on.
It's just a matter of what works. And not everybody, you see these articles, everybody should have a Roth IRA. Nobody should do a Roth. They go back and forth. It's all specific to the individual situation.
I would love to have all Roth, as you said, but the cost of doing it.
Right. The cost to get it there would have been pretty high over the last several years.
When you look into the future, you've got to make, there's nothing certain about it. So you're going to make some assumptions.
Yeah, you have to make certain assumptions. Growth rates, tax rates.
Right. And
are tax rates going to stay the same? Are they going to go up?
As things change, your strategy may change based on tax law, tax brackets, unexpected, capital gains tax sales.
And then the other side of it is you've decided that it is worth it to do some amount of conversion today. What is the best asset to convert? And most of the time you're looking at what is the most potential growth asset.
You want it to grow in a Roth.
Yeah. So I'm looking to put, and sometimes you're wrong. Unfortunately, some people convert things. I was talking to somebody who's been doing conversions, and they've been doing this one stock. And this last year, they had just done their conversion, and then not long after they did the conversion, the stock had a spinoff, and it changed, and it went down in value. And it's darn it.
Again, these are assumptions you make, and you can only hope for the best in many cases. I would encourage everybody listening right now, if you haven't already done so, many of you have, but if you haven't, give the folks at Lucia Capital Group a call. Mentioned them earlier, 800-644-1150. The things that Professor Plum has been talking about in this particular podcast are the same things that the advisors throughout all of Lucia Capital Group do, overseen by Professor Plum as the Chief Financial Planning Officer. But you know that integrating this investment strategy with the withdrawal strategy is paramount. You cannot have one without the other. Professor Plum, you would agree?
Yeah, it's not one thing to do. You've got to look at it from multiple levels, multiple angles to make sure you're doing the right thing.
Because everything you do is going to have an effect on something else.
Very much so. And so we're trying to manage to your benefit, the efficiency of your portfolio, the efficiency of your tax payments, the efficiency of those expenses that we don't like, and make it work as best as possible for that individual. And not everybody's the same.
That's the goal. 800-644-1150, the number, or go to luciacap.com. You get a lot of good information. I'm there at least 2 or 3 times a week. I like to see what else we've put up there and things that we've done in the past. I said, gosh, darn, that's a pretty darn good article right there. Go to luciacap.com, LUCIACAP.com. Invest with Lucia Capital Group. Those folks are there to help you out, make it easier for you. That's their goal. And you don't want to have to worry about this stuff, do you? When you're retired? No. Give them a call or go online at Lucia Cap. Subscribe to this podcast as well. That's a direct order from me. You can do so by clicking on the subscribe button. You can go to Apple Podcasts, you go to Spotify, and get these episodes downloaded every single week to your device. And do not miss an episode. We're pretty good at getting them out every single week. Mostly.
I know we got holidays coming up.
We do. Sometimes we got to work ahead, but we're doing the best we can. But subscribe to this podcast, and I think you'll be glad you did. Professor Rick Plum, thank you so much. I always grab you, in between appointments, so I appreciate you taking the time. I know you got to get to another thing here. We'll talk more about this stuff and more buckets in future episodes. For Professor Rick Plum, Certified Financial Planner, CFP Professional, I'm your podcast host, Johnny Dean. Thanks so much for listening. Talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.